Law firm owners, there's something worse than a trust account that's short. It's a trust account with extra money in it that you can't explain. Today's confession is about an $8,000 ghost balance sitting in a law firm trust account that nobody could tie to a client, and what we had to do to fix it before it became a real problem. Quick disclaimer though, the names, firms, and exact numbers are changed to protect the innocent, but the IOLTA nightmares are very real. Okay, let me set the scene. Picture a 3-attorney litigation firm doing around $750K a year. Good reputation, decent referrals, phones ringing. From the outside, they look like every other successful small firm. On paper, the trust account looks good too. Bank balance is positive. The software says there's money in trust. Nobody's panicking. Then they hire a new office manager, Katie. Katie's not a bookkeeper. She's not a CPA. She's just organized and a little nosy in the best way. And on her second week, she asks a simple question. Can someone show me which client this money in the trust account belongs to? Silence. So Katie starts digging. She starts with a trust liability report organized by client. The total of all of the client ledger accounts, when you add them together, comes to $72,268. Then she looks at the trust bank balance. It's $80,641. That's not good. There's $8,373 more in the bank than there is assigned to actual clients. That extra $8K is what I call ghost balance. It's not monopoly money. It's not a bonus. It's real client money that somehow lost its name tag. And that right there is the problem. Because in a trust account, every single dollar is supposed to belong to a specific client or matter. When it doesn't, you don't actually know whose money you're holding, but you're still responsible for all of it. When we dug in with them to help, here's what we found. And I want you listening to see how many of these things sound familiar. First, they had tiny leftovers on closed files. You know the drill. Client finishes their case. You think you've billed everything. You cut a check, but there's still $17.32 sitting on their ledger, or $4.80, or $63.10. Nobody's going to chase a client down for $4.80, so it just sits there. Second, they had retainers recorded in the bank, but never properly assigned in the software. Money came into the trust, it was deposited, but instead of posting it to client Smith, matter 123, it just got dumped into some generic trust deposits bucket. Third, there were transfers that didn't get matched correctly. Checks written from trust to operating or electronic transfers where the movement hit the bank but never got tied to a specific client, reducing their balance. Individually, none of these felt like a big deal. A few dollars here, a few hundred there, spread over several years. But when you zoomed out, all of those little mistakes added up to roughly $8,000 of money in the bank that didn't belong to anyone on paper. That pesky ghost balance. Now, you might be thinking, okay, but at least the account isn't short. Isn't it better to have extra? No. From an ethics and audit perspective, unexplained extra is just as bad as unexplained missing. Here's why. You can't just decide it's your money and sweep it into your operating account. If you do that without being able to show exactly whose money it used to be, you basically paid yourself with unidentified client funds. In an audit, when the bar or an accountant looks at your three-way reconciliation and sees the bank balance is higher than the total of all your client ledgers, their simple question is, whose money is this? Show me. If you can't answer that, it doesn't matter that your intentions were good. On paper, it looks like you've lost track of client funds. That's not good. Ghost balances are the accounting version of, I'm holding a pile of other people's money, I just don't know whose it is. Bar associations and auditors don't like that. So here's exactly what we did with this firm to fix the problem. Step one, we pulled the trust ledger balance versus the bank balance, and we went month by month by month. We went back in time, and for each month, we compared the total trust ledger amount by client, and then we compared the trust bank balance for that month. Why did we do that? We were looking for the month where the numbers first stopped matching. That tells us when the ghost first showed up. Step two, once we found that window, we zoomed in on it and fixed the problems. Once we knew, okay, June 2023 is when this got off, we went into that 2 to 3 month window and traced every deposit into trust, every check or transfer out of trust, and then we asked, can we tie this to a specific client matter? Anywhere we could, we fixed the ledgers, we posted retainers properly, we closed out leftover tiny balances that should have been refunded, and we corrected miscoded transfers. And then we just went month by month by month until that was all done. Then step 3, we created an identified funds client like in the ledger, to handle those funds we genuinely could not tie to any specific client. No notes, old files closed, no way to reasonably construct it. True ghost funds, and this does happen. For that portion, we created a single unidentified funds ledger inside the trust records, sort of like another client, and we moved that amount there with detailed notes on everything we have tried. Now, when you ran the reports, the total trust liability, when you included this new unidentified funds client, matched the trust bank balance. The mathed. The last thing to do after all this was to figure out what to do with these unidentified funds. As you might expect, this isn't the first time this has happened. Not this firm, it's happened all the time. Okay, you lawyers are not great with money. You're not great with records all the time. You're not bad people. I'm one of you. You're just not organized. So this isn't the first time this has happened. Most states have a protocol. In this case, we just follow the rules of the state. In a lot of places, this means you can't just keep it. The key part of the story, though, we didn't hide it or bury our head in the sand. We documented it, separated it, and had a clear story if anyone ever asked. Now, if you're listening to this and thinking, I have no idea if I have ghost money in my trust account, here's the truth. If your bank balance is higher than the total of your client ledgers and you can't clearly explain why, you already have a problem. You might just not have had a new office manager brave enough to ask you the question yet. In a minute, we'll walk through a simple 3-step ghost balance check you can run this week. But the big idea of this week's confession is this: extra money in the trust is not extra until you can prove whose it is. Until then, it's a ghost, and you are responsible for it. Okay, confession time is over. Hopefully you enjoyed that. Now let's hit the mailbag.
Mailbag.
Welcome back to another Big Bird mailbag, where I answer real questions from law firm owners about their books, their trust accounts, and saving on taxes. If you have a question you want answered on the show, leave a comment and I will work it in. Okay, let's just get right to it, okay? Question number 1. By the way, I think I said this the last time. I want to have a mailbox where I pull out, like your questions, but I don't have it yet. Eventually. Question 1. Julian from Savannah, Georgia asks, Chris, I get a million reports from my software and my bookkeeper. As a law firm owner, what are the reports I should really look at every month, and what am I supposed to be checking on each one? Great question. Pretty simple, pretty straightforward. If you get a ton of reports, ignore most of them, particularly on a monthly basis. What I would be looking at if I were you is your P&L. You really want to see top line, how much money came in and how much money went out. You would like that to be a positive number when you look at those two every single month. If that's the case, the next thing that I probably would look at if you're organized in this way is how much money came in and how much money did it cost to perform the service. Typically, this is going to be for human capital. Okay, so paralegals, attorneys in their time working on the cases, this is going to show you your gross profit and tell you if you're priced right. You want your gross profit to be about probably the 65% mark. So you're spending about 35% on labor, on materials maybe, like printing and stuff like that. But you want to check that number. And then the third thing I would look at on your P&L is variance. Is your ad spending 10x this month what it was last month? Is your subscription to Claude 10x what it was last month? These are going to be things that you're going to catch that are going to be problems to be fixed, that are going to throw off your expenses in your P&L. So I would look at that. I also probably would look at your balance sheet. Balance sheet is going to just roughly show you the health of the firm. How much money is in the bank? What's your credit card debt looking like? Hopefully those things look healthy and look good. And you can tell what kind of cash you have on hand. So if you're going to make some hires, if you're going to buy something, that type of stuff. Those are the things that I would look at. Those two things. All right. Question number 2. Maeve from Flagstaff, Arizona asks, be honest. How bad is it really if I put some personal expenses on the firm card and then my CPA just books them to owner draws at the end of the year? Everybody I know does this. Is it actually a problem or just not ideal? Okay, Maeve, it is really both. Okay, it is actually a problem and it is also not ideal. The reason it's actually a problem is this. If you're putting personal stuff on your business card and then trying to back in and fix that later, you're probably missing things. If you get audited, you're going to get stung for that. Okay, they're not going to like that. My guess also is if you're putting personal stuff on your business card, you probably are also sometimes putting business stuff on your personal card, thinking you're going to also sort of true that up at the end. And the fact is you're going to forget. It's not going to work. Okay. When you have these things happen, by the way, also, if you do get audited, The auditor is going to see these things and believe you to be someone that has bigger problems, and they're going to keep digging. This is not good. Okay, so super simple to do this. Have a business card that you put your business stuff on. Have a personal card that you put your personal stuff on, and never the twixt shall meet. I think is what they say, something like that. Okay, just don't do it. All right, number 3, Soren from Duluth, Minnesota asks, my firm did about $450,000 last year, and I'm still doing a lot of the bookkeeping myself with some help from my assistant. At what revenue level or complexity do you tell people you should not be the one touching the books anymore? So you're probably not going to like this answer, but it's a completely attorney answer, which is it depends. It's different for everyone. If you're a nerd and you like to do your own books, you're probably going to do them a lot longer than someone that doesn't. When it's time to have someone else do your books, there's going to be sort of 2 big things that pop up, 2 big red flags. Number 1 is going to be when you haven't done your books for like 2, 3, 4, 5, 6, 7, 8, 9, 10 months in a row. That's when you should have somebody else do it because you're just not doing it. Okay. The other sort of red flag or the other sign that it's time to have someone else do it is when you turn your books over to your CPA at the end of the year and they tell you they're all jacked up. And then they have to go do a bunch of work to fix them up. They charge you a tremendous amount of money, and you could have just paid somebody a mere pittance to do it for you on a monthly basis, have the books clean, give them to your CPA, and then know also in real time how healthy your business is. So those are kind of the 2 things that I would say. Most people, if you want to have a real number around the $300K a year mark, probably start to look to outsource the bookkeeping. It's not super expensive to do it if you hire the right people, right? They won't overcharge you, and the value that you'll get will be great. And at about that time is when I would say you want to invest in somebody like that. That's why our thing is, if you're making $300K to $1 million, we're the people for the job. All right, that's it for the mailbag. It's over. If again you have questions, send them somewhere where I can find them, and I'll include them. All right, hope you enjoyed it. Let's head to the next segment. Tax time. Up next is everyone's favorite part of the show, Big Bird's Tax Corner, where we help you keep more of you earn by lowering your taxes. Cue the graphic. Welcome back to Big Bird's Tax Corner, where small law firm owners learn how to legally pay less in taxes without doing dumb stuff that gets you in trouble later. Today's topic, is this really a business expense? Because if you've ever stood at the register wondering whether to put something on your firm card or on your personal card, this is for you. Most firms don't get in trouble because they don't know tax code section numbers. They miss out because they're so risk averse they count a lot of business expenses as personal expenses, and in doing so, miss the opportunity to write them off. I'm talking about like a 35% discount on something like that, ish, 30 to 35%. So I want to give you a stupid simple 3-question test you can run on almost any expense. Question number 1, is this ordinary and necessary for running a law firm like mine? Plain English, would another reasonable firm in your practice area and size say, yeah, that's a normal cost of doing business? Case management software, bar dues, malpractice insurance, marketing, staff, technology, all of these things are reasonable and necessary. ChatGPT, yes. Okay. Anthropic or Claude, yes. Easy yeses. Now, a new TV for your living room so that you might watch CLE on it? Probably not. A TV in your office? Yes. Okay. If you have to bend over backwards to explain why it's ordinary and necessary, it probably isn't. Okay. Just use your head. Question number 2, is the primary purpose business, not personal? This is where knowledge is power. Okay. When making this determination, it's important to know that the purpose doesn't have to be all business, just primarily business. What we're really talking about here is meals, travel, things like that you want to write off. Okay. Your normal expenses, your stuff, that's going to fall under question number 1. Okay. So dinner with a friend to talk shop, business. Traveling for a Friday CLE and meeting a colleague on Monday for breakfast to share notes and writing off the weekend in between, business. And I'll teach you about that in another tax corner. Okay. Find the business in the thing and write it off is what I would say. 3rd question, and this is where most people blow it. Could future you explain this expense with documentation a year from now? Okay. And here's the real tip. Here's the real truth. Something that people freak out about all the time. You don't need a receipt. The fact is, you've already got a receipt. Your credit card transaction. Okay. Your Amazon cart shows you all of the things that you purchased. What you need to be able to do though is explain what the receipt signifies for stuff it's super easy. Okay. When you're networking, when you're doing a business trip, it's a little bit trickier. Okay. What's the easiest way to do this? How do I do this? I put everything in my calendar, okay, including why I had the meeting and what was discussed. It's usually on your phone. It takes 30 seconds. And again, you can pull it up easily if you are asked. If an expense passes all three, number one, ordinary and necessary, number two, primarily for business, and number three, you could explain it later with actual documentation, you're probably in safe territory. If it fails one of those, either don't run it through the firm or expect your CPA or your bookkeeper to ask you and kick it back. And if you can't even pull a clean list of what you spent last month because your books are a mess, tax strategy is a fantasy. You can't optimize numbers you can't trust. That's exactly what I fix in the Trust in Books checkup. We look at how your books are set up, where business and personal are bleeding together, and what I change so you can actually plan instead of pray at tax time. That's it for the Tax Corner. That's it for the Confessions of a Law Firm Bookkeeper. Listen for this ad at the end. Let's go. Real quick, if you're a law firm owner doing between $300K and $1 million a year and you're not confident your books and trust account would survive an audit, I'm offering a free Trust in Books checkup for your firm. We'll review your setup, flag any real risks, and outline a cleanup plan. To book yours, go to bigbirdaccounting.com/checkup.